Some of your friends or relatives may have made a lot of money in real estate. Someone bought a property for 20 lakh in 2004, which is now worth 2.5 crores. Someone else bought a flat for 1.5 cr 3 years ago, which is now say double, about 3 cr. This kind of appreciation may confuse certain investors about where to invest their money, and they start comparing equity and real estate returns. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of investing and personal finance. In today's video, we'll discuss two things. How have real estate and equities performed in the past, and have real estate returns been better than equities? Next, if you want to invest in real estate, what are the things you need to keep in mind? So without any delay, let's start. Historically, both equities and real estate have been wealth creators. So in 1986, my uncle bought a flat in Mumbai for 75,000 rupees. Today, that flat is worth massive 1.4 crores. This means he received a return of 14.7% over 38 years. But had he invested that money in UTI MasterShare, India's first equity-oriented fund launched in October 1986, he would have received a return of 15.9%. Today, his investment would be worth 2 crores. Understand two things here. First, over 30 to 40 years, a difference of 1% to 1.5% matters a lot. Second, equity returns are good, but real estate returns are not bad either. At that time, there was only one mutual fund, and perhaps no investor could invest 75,000 rupees at once then. But if we talk about the last 5 or 10 years, the situation has changed significantly. Take a look at your screen. In the last 10 years, only Bangalore and Kochi have delivered returns of over 7%. And if we talk about the last 5 years, except for Bangalore, no city has been able to beat the nominal 6% inflation rate. In fact, in Delhi, it is less than 1%. Meanwhile, the Nifty 50 has delivered over 16% and 14% in the last 5 and 10-year periods. You might know people who invested in Gurgaon and saw their money double or triple in the last 5 to 10 years. However, if you had invested 1 lakh in Tata Elxsi's stocks 15 years ago, it would be worth 85 lakh rupees today, 85 times. Now, there are many location-specific and stock-specific success stories, but we are discussing broader markets, not specific pockets or stocks here. Many invest in property for rental income, finding real estate attractive due to appealing rents. If you look at the latest data on rental yields from real estate consultancy Anurag, there has been a surge in rental yields. In simple words, rental yield means the percentage of the property's market value that you receive as annual rent. You can check the rental yield of India's top cities on your screen. In 2019, 3.6% was the highest rental yield, and in the first quarter of 2024, 4.45% is the highest. In fact, in Q1 2024, except for Mumbai, Gurgaon and Bangalore, it is less than 4% in other cities. Rents have increased in 2024. For example, in Bengaluru, property prices have increased by 6.5% and the rental yield is 4.5%. So effectively, your return is 11%. So there are two things here. One, historically, rental yields in India have been between 2.5% and 3.5%. This might be the first time in the last 20 years that rents are this high. So it's hard to say how sustainable the trend is. Number two, rental yields like those in Bengaluru, Mumbai or Gurgaon won't be found in every city. They can also vary according to the city and area. So why has there been a slowdown in real estate? Well, basically in the last 10 years, real estate has gone through a lot of changes. For instance, the implementation of RERA. It was an unorganized sector. Builders like JP, Amrapali and Unitech launched new projects but went bankrupt. Buyers faced a lot of delays and some people haven't received possession to this day, which dampened sentiments. And because of these delays, housing sales took a hit while there was decent inventory, and due to such factors, the sector experienced a slowdown. Then on May 1, 2017, RERA was implemented, which tried to organize this sector and things started getting better. Well, no one knows how any asset will perform in the future, but before investing, you can keep a few things in mind. First, you can see real estate investing as buying an individual stock. Your property investment might give you excellent returns, but there is also a high possibility that property prices remain stagnant for years. Let's talk about a friend of mine who is a property investor. 5 years ago, he bought a flat in Gurgaon for 1.25 crores, which is now valued at 2.5 crores, which is 2x. At that time, he also bought a flat in Delhi for 55 lakh rupees. Now, 5 years later, he is getting offers below the purchase price. The second point is involvement. When you invest in something like property, you have to be personally involved in many things. For instance, ensuring your tenants are good, the property is well maintained, its maintenance cost, and so on. Then, whenever you rent it out, you have to deal with a broker. The point is, compared to other financial assets, you have to invest more time in property. Plus, the big ticket size, if prices don't increase as per your expectations, it could be disappointing. And if a tenant doesn't vacate the property, that's another hassle. But with equities, you can start your investment with just a few thousand rupees. If you want to invest in real estate with small amounts like equities, REITs are an alternative. REITs stand for Real Estate Investment Trust. It's like a mutual fund that invests in real estate. Here you can earn 7 to 10% pre-tax. To understand this in more detail, you can watch our other video. The link is in the description. The point is, compared to other investment classes, understanding the real estate market is crucial before investing, as it's not just a few thousand rupees. If your investment isn't right, you can't exit or sell it quickly. You need to understand both the rewards and risks associated with it. To sum up, property investors have historically received good returns. However, in the last 10 to 12 years, there has been a slowdown in property returns. Rental yields in 2024 seem quite attractive, but how long this trend will sustain is yet to be seen. You can still find good deals in some cities today, but just like you research for a stock, you'll need to put in effort to choose the right property. Real estate investment can also be time consuming because you have to be personally involved in everything like repairs and maintenance, dealing with tenants and brokers. On the other hand, mutual funds or equity investments can give you better returns, and you can manage all your investments from home at the click of a button. And with this, we have come to the end of this video. If you liked the video, please like, share and comment, and don't forget to subscribe to our channel.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.